and welcome to The Firm, India's only show on corporate law, tax and audit. In fact, from all my conversations here in Davos at the World Economic Forum's annual summit, I've gleaned that this is probably the world's only such show. And if not, it's definitely the only such show that's coming to you from Davos. Here's what we have lined up for you on the show this week. Tax avoidance is not equal to tax evasion, says the Authority for Advanced Rulings. That's good news for India Inc. Rohan Shah of ELP tells you what to expect from Budget 2010. And a special conversation from Davos with Dr. Aniel Cabrera of the Thunderbird School of Global Management, the first school to introduce a professional oath of ethics for its students way back in 2004. Dr. Cabrera has now introduced and worked on a global oath for young business leaders. A new trend in governance: catch them young. All right, let's start with the big story this week. The Authority for Advanced Rulings has said that tax planning, tax efficiency and tax avoidance by companies is not equal to tax evasion. I can go on more and more about that ruling, but I'm not, for two reasons. First, it's cold, and secondly, because Isha Dalal has more on what impact this has on India Inc.
It's a transaction that's created the country's largest cement maker and, as some thought, a large tax liability for the Aditya Birla Group. In October last year, group company Grasim demerged its cement business into a wholly owned subsidiary Samruddhi Cements, which was then to be merged with another group company, Ultratech. This transfer of assets was undertaken to bring the group's cement operations under one legal entity and is structured as a court-approved scheme of arrangement. Had Grasim's cement business been sold to Ultratech, it would have been subject to long-term capital gains at 22%. But by choosing the amalgamation route, the transaction could avail of a capital gains tax exemption under Section 47 of the Income Tax Act. An exemption that some experts thought would not pass muster with the revenue. Would the tax efficiency be interpreted as tax evasion?
We believe there is no tax liability that arises out of this transaction at all. We have the best brains in the country. The sort of finest legal experts who've opined on this. Very clearly, I don't think that there is any question of a capital gains issue in this transaction.
The Birla position is backed by case law. Whether it's the Supreme Court judgment in 1967 in the case of A. Raman and Company, or the Gujarat High Court decision in 1977 in the case of Wood Polymer, courts have held that avoidance of tax liability by so arranging commercial affairs that charge of tax is distributed is not prohibited.
All of these case laws dealt with a situation that under what circumstances can the tax administration lift the corporate veil? Under what circumstances can it look at a tax evasion device being resorted to by the taxpayer to plan its affairs? And there, all of these decisions which were rendered by the Supreme Court for periods ranging between 50 years to 80 years back were referred to. And it said a combined reading of all of these decisions suggests that the taxpayer is well within his rights to organize the affairs of his business such that he is able to claim benefit under the provisions of the law. And you cannot attribute a motive to the taxpayer that he's claiming this exemption with a view to evade taxes.
This Section 47 exemption for schemes of arrangement got a shot in the arm earlier this month thanks to a ruling by the Authority for Advanced Rulings, or AAR. Here's what happened. Star's Indian entertainment channels, Star Plus, Star Gold, Star One and Star Utsav are owned by overseas entities based in the British Virgin Islands and the UAE. The global parent wanted to merge these entities with its Indian company Star India Private Limited, or SIPL, and claimed the Section 47 capital gains tax exemption. But the department held that Star had taken resort to the scheme of amalgamation for the mere purpose of availing the benefit of exemption under Section 47 by putting on the mantle of amalgamation on transfer of shares of channel companies to the Indian companies, and therefore the transaction should be liable to tax. The matter went to the Authority for Advanced Rulings, and the AAR disagreed with the department. Its ruling says that it is within the legitimate freedom of the contracting parties to enter into a transaction which has the effect of extending to the party the benefit of exemption under the taxation statute. The contracting party is not bound to enter into a transaction in such a way that it results in tax liability while foregoing the benefit of exemption under law. That's good news not just for Star but across India Inc.
A ruling given by the authority on advance ruling is binding only on the taxpayer who's seeking this ruling. So in a nutshell, this ruling is binding on Star TV and the group that has sought the ruling with respect to exemption that's available on a transaction of this kind. Having said that, sometimes rulings have a persuasive impact if the facts of the case of another taxpayer are similar. So if you bring forth another taxpayer whose facts are similar to the Star TV's case, then this ruling will impact them as well positively.
No wonder corporate houses are breathing a little easier. S. Gayatri, direct tax head at the SR Group, explains that the AAR's ruling, by clarifying the revenue's position, helps in planning future transactions or mergers between group companies.
Certainly it gives a lot of comfort. It makes us a little more upbeat, because in the backdrop of recent decisions that have been coming up, like I said, pointing to a situation where the department has been very aggressive in looking at or evaluating various deals and transactions. It is a very nice calming effect. That's what this ruling has, and we are confident therefore that if the facts support us and if the context supports us, certainly whatever is legitimate, whatever is valid in the eyes of law cannot become invalid merely because it also results in tax being saved.
After the Vodafone dispute has erupted, there is a fear in tax circles that everything is going to be questioned for tax evasion. And really whatever you do, the tax officer will go behind you and recover taxes. This ruling actually addresses that fear. This ruling analyzes the fact that tax evasion and tax planning is different. If there's a genuine business transaction and tax planning happens because there are ways to actually structure the transaction in tax laws and actually land up paying no tax, then one cannot say it is tax evasion, and those things are also still valid under law.
But the celebration may not last for long. The new direct tax code proposed last year suggests the inclusion of general anti-avoidance rules or GAR in the income tax regime. Rules that experts are afraid would put a whole host of legitimate transactions under the tax scanner, and rules that would of course put an end to the comfort that this AAR ruling brings. In fact, with the timelines for the implementation of the direct tax code still unclear, many experts are afraid that general anti-avoidance rules could come in this year's budget itself. And if that happens, the fine line between tax planning and tax evasion will become an easy one to cross. In Mumbai, Isha Talal.
With that, we need to take a quick break on the firm. When we come back, Rohan Shah of ELP tells you what to expect from Budget 2010.